You see the presentation?
I can see it.
Amazing. If you can see it, then everyone can see it.
Yeah, that's correct. I'm not special, unfortunately.
You said that. All right. Hello, everyone. Before I introduce myself, this presentation is brought to you today by Kastner Tax Solutions. Yes, that's my business name. You may have heard rumors that learning about taxes is downright boring. Well, you're about to discover that those rumors are indeed true. Having said that, my intention is to make the process tolerable, and I will do my best to keep it short. That won't be very difficult since I really didn't prepare that much to say. I'm not an investment advisor, but I can try to lower your level of anxiety just from the thought of investing by showing you how taxes work, and I'll present it in a simplified manner. Just one caveat, simplified doesn't guarantee that you will even attempt to understand everything. It just means that you can understand it if you want to, and even if you don't want to, I don't mind repeating it again when it becomes more relevant for you. All right, hi, I'm Yaakov, also known as Kenneth, and you should not care. But since we are together, captive for the next 20 minutes or so, we might as well make the best of it. Yaakov Daniel is my Hebrew name, and you should all feel free to call me Yaakov. Kenneth Daniel is my legal American name, so I started using Kenneth as my business name, especially when dealing with clients outside of Israel. Many of the people I meet on LinkedIn automatically think I want to be called Ken for some reason, even though nobody ever called me Ken in my life. If anything, maybe Kenny when I was a baby. Actually, when making Aliyah, since my official name was Kenneth, they put that down in Hebrew on my Tudat Zehut. So without vowels in Hebrew, everyone thought it said Kent. Eventually, I changed my legal name in Israel to Yaakov, but in the US, I'm still Kenneth or Ken, Kenny, whatever. Speaking about Aliyah, I bet I have the most boring Aliyah story ever. I got on a plane in New York, and 10 hours later, I was in Israel. That's pretty much it. It was the first time I was ever in Israel in my life. I was 13 years old plus 1 month at the time. The year was 1994. I came with my parents and siblings. We lived in Yerushalayim. I had a tough time in school and high school. I had a tough time in the army. I'm not going to pretend that it was easy, but I made it this far. I went to Hesder Yeshiva in Kerem B'Yavne, got married, went to college in Machon Lev, and for over a decade now, I live in Ramat Beit Shemesh with my wife and 4 children. I'm a CPA here in Israel, and I'm also an enrolled agent certified by the IRS. For those who don't know, the IRS is the American Federal Tax Authority. I know not all of you are Americans, and it's for Americans, it's kind of like a scary thing to hear, IRS. Don't be scared if you're not evading taxes. For over a decade, I get paid to do what most people despise, providing tax consulting and prepare tax returns. Before I started Kastner Tax Solutions, I most recently managed a team of about 15 people, providing tax services to thousands of Israeli clients. Before that, I worked in the International Tax Department in EY, previously called Ernst & Young, which is the largest accounting firm in the world. And my specialty is US real estate for foreign investors. All right, US real estate for foreign investors, hence the title of this presentation. That means Israelis who invest in the US. Okay, I help them with their taxes. On that note, you will notice that I will not be reading the slides, rather I will be elaborating on them, since my basic assumption is that everyone here can read English. After all, this is ESN. My target audience for this presentation is everyone watching this. You don't have to be American at all. Even better if you're not, but Americans are also fine. That's because I will be directing my attention to anyone, but specifically Israelis, who might invest in US real estate in the future, or to anyone who knows someone who might invest in US real estate in the future. So now you understand why I'm speaking to everyone here. It's all relevant. So before we move on to the next slide, I want to take a step back. Why do so many people invest in US real estate? Like I said, I'm not an investment advisor and I don't sell real estate, but I heard that you can make a much higher passive income on US real estate rather than investing money through your local bank. That's what they say. I don't know. Maybe someone else can give a future presentation on ESN elaborating on this issue. All right, if I didn't put you to sleep yet, it's about to happen anytime now. That's why I brought a surprise to keep you awake for another few minutes. Watch this. Helena, you don't even know this surprise. Watch. I didn't even practice it myself. See this? Tennis balls. New package.
Are you gonna juggle?
Oh, I was just gonna say, I love the pop.
Oh my gosh.
No,
the pop.
smell.
I think
we set them
Smell
on
after
fire.
the
The
pop.
pop and the smell of new tennis balls.
You like that, huh? I wish I can transfer the smell over on
Smell-o-vision.
the computer.
Most of us can know the smell well enough to imagine it.
All right, so imagine it now. Don't close your eyes. Watch. All right. So what do people usually do with tennis balls? They play tennis. But I got a better idea. Watch this. All right. Let's start off by splitting the entire world into two groups. Okay? Americans and everyone else. Okay? Americans have to report their income from anywhere in the world. Doesn't matter. Doesn't matter where they live. Doesn't matter where they work. So, for example, a U.S. citizen who was born in Israel and never stepped foot in the U.S. is required to report to the IRS every year. But we won't focus on that. You can see I'm out of practice. Everyone else, besides for the Americans, everyone else is taxed by the IRS only for their U.S. sourced income, if any. The definition of U.S. sourced income is not as straightforward as you might think. But continuing the theme of keeping things simple, you don't have to worry about that today because our topic, real estate, is clear. Real estate can't move around. It's connected to the ground. So if the house is on U.S. soil, any income from that house is U.S. sourced. Simple. When a U.S. person who lives in the U.S., a U.S. person who lives in the U.S. has rental income from a house in the U.S., they pay tax in the U.S., right? But what happens when the person with the U.S. rental income lives outside of the U.S., for example, here in Israel? Remember we said that the U.S. taxes its citizens on their worldwide income? I'm not sure if you were listening or watching the balls drop. In a similar way, Israel taxes its residents on their worldwide income. So now we have a problem. The U.S. wants tax because the house is on U.S. soil. Israel wants tax because the owner of the house is an Israeli resident. All right, so who gets the tax? Who gets the money? In comes the tax treaty between the U.S. and Israel, which says that when it comes to real estate, okay, every different type of income has a different section in the treaty. When it comes to real estate, the country with the house on its soil gets first dibs at the tax. Okay, in this case, the U.S. gets first dibs. Israel can get any leftovers. What are these leftovers? I'm glad you asked. I will answer with a simplified example, in tune with the simplified nature of this presentation. Let's say there is $100 of rental income. On $100, let's say that generally the US taxes 10% and Israel taxes 15%. Okay, this is just an example, not real percentages. So without a treaty, the poor Israeli investor might have to pay 10% plus 15%, meaning 25%. However, according to the treaty, he will pay 10% to the US and only another 5% in Israel. That's the leftover, only another 5% in Israel. Bottom line, there's no double tax in this case. Rather, the investor ends up paying the amount that is equal to the tax of the country that has the higher tax. In this case, Israel has the higher tax, 15%, so he'll pay a total of 15%. And the treaty just tells us how to split it up, how to divide it between the two countries, 10 to the US and 5 to Israel. Okay, it's usually around this time that people start to look at their watches and wonder when the presentation will be over. There's no progress bar at the bottom of your screen, so I'll just tell you that I only have 3 more slides, and the third one says thank you. On LinkedIn, recently someone posted claiming that FERPTA is a type of fish. Don't believe him. Please, FERPTA is a tax law from like 40 years ago. It's not a fish. Actually, it was I who posted it on LinkedIn.
You've
Anyway,
learned something since then.
what?
I hope that you've learned something since then. FERPTA is not a fish.
That's right. I posted that it's a fish, and I learned for myself in the same post that FERPTA is actually not a fish. It was a very fun series of posts on LinkedIn if you want to go check them out. But back on topic, FERPTA stands for Foreign Investment in Real Property Tax Act. That's the name of the law. Okay, and one of the things it says there is that when a foreign person sells U.S. real estate, okay, think about it. The foreign person is the seller. Foreign person sells U.S. real estate. The buyer must withhold 15%. That means separate 15% of the sale price, okay, and send that to the IRS. Okay, that 15% is usually a lot more than what the foreign seller actually owes the IRS for the profit on the deal. Okay, but the IRS wants to make sure that the foreign person doesn't run away with the money to a foreign country where the IRS doesn't have jurisdiction. Okay, so in the example, if the sale, if he's selling a house for $100,000, then $15,000 will go to the IRS temporarily, and the seller will only get $85,000 in the meantime from the buyer. What about the other 15? How can the foreign seller get back that money, right? Because that's too much tax. It's an over withholding. So there are 2 options. One option is wait till the following year and file for the credit on your tax return. Okay, this means that you can potentially have to wait over a year until you see the money from the IRS. Okay, because what happens is, especially if the sale takes place in the beginning of a tax year, let's say January, February, March, the next time you can file a tax return is only a year later for that year. Okay, it's only in the next year, so that's already a year, and then it takes the IRS up to 6 months to send back the refund. So sometimes it can be even a year and a half or more until you see the money from the IRS. So there's a second option. Second option is you can prevent it. You can prevent the withholding to the IRS by requesting a withholding certificate from the IRS before the date of the sale. Okay, don't try this by yourself. There's a lot of paperwork. There are a lot of things that can go wrong. Hire a professional who specializes in FERPTA, and lucky for you, you're staring at him right now. Hi. If you request the withholding certificate, what's going to happen? The buyer won't send the funds to the IRS. Rather, he can keep the money in escrow with the lawyers until the withholding certificate arrives from the IRS, and then the buyer can release the funds to the foreign seller according to whatever it says on the withholding certificate based on the actual tax that the seller owes based on the gain, not based on the sale price. So what else should you know about US taxes for real estate investors? First thing is plan before you invest. Please, I'm speaking from experience. Both US and Israeli tax planning. Okay, this is critical since most US accountants located in the US are not familiar enough with foreign issues. And because of that, I've seen more tax disasters than I ever asked for. Here's an example. There's a very popular trick that many real estate investors take advantage of. It's called 1031 exchange. You don't have to remember the number, don't remember anything. It's a way to defer taxes, and it works really well for Americans that live in the US. However, for foreign investors, it can be a double taxation trap, and I've seen investors fall into this trap. Had they come to me earlier, we could have prevented it. That's really all you have to remember. Just send them to me. Entity structure on the top line. Entity structure planning means what type of entity will own the investments. You can own the investments by yourself through an LLC, limited liability company, through a corporation, maybe something else. There are numerous options and there's no one size fits all. All right, the third line, we have all these odd looking things. So what's the common denominator of ITIN, SSN, and EIN? The answer is they're all TINs, of course. You're all asking what? Whoever's listening is staring at me with a blank expression. TIN, T-I-N, means taxpayer identification number. That's the number that goes on your tax return so the IRS knows who you are. ITIN is individual taxpayer identification number, which is a tax number for anyone not eligible for an SSN or social security number. EIN literally stands for employer identification number, but it really means entity identification number, meaning the tax number of an entity such as a corporation, a partnership, etc., that they would put on their tax return. Point is, foreign people naturally don't have US TINs, so they need to apply for an ITIN in order to be worthy of filing a US tax return to the IRS. Next line, depreciation. Depreciation is a concept that every real estate investor needs to know about. Okay, depreciation is an expense for tax purposes, but there's no cash transfer involved. Okay, how does that work? Think about when you buy a house for investment and you rent it out. Okay, you're likely going to get rental income. Okay, you have to pay tax on income, but you can lower that tax by reporting expenses that you paid in relation to the house. Examples would be maintenance expenses, management fees, utilities, property tax. Property taxes like Arnona here, HOAs like the Vad Bayit. In the US, people also need to understand it's different than Israel. In the US, these expenses are typically paid by the owner and not by the renter. Okay, like utilities, Arnona, Vad Bayit. In Israel, usually the renter pays for these things. Anyway, what about the house itself? Isn't that also an expense that I can take to lower the rental income? And that would eliminate all my rental income, right? So not exactly. That's where depreciation comes in. The IRS and most tax authorities worldwide don't allow you to take the house as an expense all in the first year. They allow you to spread out the expense over a certain amount of years, typically in the US, 27 and a half years for a rental property, residential. And you take a portion of the house as an expense each year. Okay, as an expense, you don't pay anything, but for tax purposes, you take it as an expense and it lowers your income and lowers your taxes. That's depreciation in a nutshell. Cost segregation takes depreciation one step further. Okay, if you hire somebody to do a cost seg study, by the way, I do not provide that service in-house, you can potentially be able to report a larger portion of depreciation each year and save more taxes. Okay, just be aware of that. The study is usually worthwhile for properties that are worth more than $1 million. Next up is state tax. All right, so in addition to the IRS, there is usually also a state tax to the state where the property is located, New York, California, Michigan, those kind of states, not state of mind. The rules are different in each state. Some states don't even have a state tax. For example, Florida doesn't have state tax for individuals. Okay, and don't confuse state tax with estate tax, the last line in the slide here, which is the tax imposed on a person who dies. Okay, this is important for foreign investors since the death tax, as they call it in the US, can be up to 40% of the value of the property that the investor owns in the US. Okay, so if you invested in a property, $100,000, after you die, you can only get $60,000 to give to your kids. Doesn't make much sense, right? So that the 40% part is actually the same for Americans as it is for foreign people. The difference is that Americans have an exemption of like $11 million worth of assets, or 22 million if we're talking about a married couple, as opposed to foreigners who only have an exemption of $60,000 worth of assets in the US. Okay, so foreign people who invest in the US are kind of in trouble. So there are several ways that you can mitigate the risk of having to deal with estate tax. And for that, you would need to speak to your friendly tax advisor. On that note, I will end the presentation. Yay, but I'm not going anywhere until 4 o'clock. So feel free to ask me any questions either now or by email. And don't forget to follow me on LinkedIn. Thank you very much.
Thank you. Do you want to stop sharing your screen, Yakov? Awesome. So firstly, a round of applause. That was fantastic. Really, really enjoyed that.
Can I also do it myself?
Particularly the juggling. That's the first time anyone's ever juggled at ESN. So well done on being the first there. Does anyone have any questions? No? Okay. It was
Not all at once.
Actually, I do. I do have a question. A lot of what you said, yeah. One question in particular. You mentioned 1031 exchanges can be a trap. Is that in general or only for people who are not U.S. citizens?
Only for people who live outside the U.S. Not
Even
necessarily
if they are U.S. citizens.
Even if they are U.S. citizens, if they're living in a different country, for example, in Israel, so they're accessible. They have to pay, they have to pay taxes in Israel, unless they're in the first the first 10 years of making Aliyah, and they don't have anything to do with Israel. But if they're paying taxes and they're a tax resident of a different country, then they could be in trouble if they defer tax in the U.S. Because what happens is Israel is not going to respect that tax deferral, so you're going to have to pay tax in Israel on that capital gain. Mm-hmm. Okay, and then eventually in the U.S., when you pay the capital gain, years later, you won't be able to offset that with the Israeli tax that you paid, as opposed to if you do it all in the same year, then like we said, you only pay the higher amount of tax, capital gain tax, and this way you'll end up paying double tax.
But this can be ameliorated through careful planning, I take it.
Sorry?
I take it that this can be ameliorated through careful planning?
Yes, absolutely.
Great, thank you. Looking forward to being in touch with you.
Any more questions?
Yeah, how do you get a tax number in the States if you're not a U.S. citizen?
You need an ITAN. So that's a good question. In order to get an ITAN, the form is called W-7. Okay, you're supposed to fill out an application to get an ITAN. The problem is that together with this application, you're supposed to attach your original passport with the application and mail it physically to the IRS. And, they're dealing with how many 20 million pieces of paper right now because of COVID or whatever. And even before Corona, good luck getting it back from the IRS. You need your passport, for heaven's sake, right? So what the IRS did was they appointed agents all over the world that could identify the person requesting the ITIN instead of the IRS. Okay, they're called CAAs. Okay, certified acceptance agents. Okay, yes, I'm one of them. And you can go to that person and just show them your passport. And all I need to do is make a copy of the passport and send the copy to the IRS with my signature saying that I saw the original passport. Okay, this is not a notary service. You can't take a notarized passport and send it to the IRS. They're not going to accept that. Okay, only a CAA can do that. And then it's a process of you still have to mail it into the IRS, and usually you do it together with your first tax return. It's usually not separate from the tax return. Usually the application for the ITAN is sent in together with your first tax return, and you get the number after a month or two.
Any more questions? I have a question. Who is a good referral partner for you? So who would be helpful for you to meet to kind of gain more clients, as it were?
I think there are a lot of investment companies here in Israel, or big and small, that offer U.S. real estate investments to Israelis. So I guess if anybody's in touch with those companies, they can be a good referral base. They have all their investors, and they need to refer them to somebody to do their taxes. So that that would be ideal. I guess anybody else, even there's a lawyer here also. So I guess any lawyers, attorneys that that would be helping the Israeli investor, on their side, looking over their contracts or whatever it is. Unfortunately, a lot of Israelis don't take a lawyer to do these transactions, and they regret it later. But assuming, the smart ones that go to a lawyer, so assuming the lawyer doesn't prepare the tax returns, the lawyer could also refer those kind of clients to people like me.
Okay,
Thanks, Emmanuel.
perfect. So great. Any more questions? Wonderful. Okay, great. So I'm going to open the breakout rooms now. It's now 3:10, so I'll close these at about 3:20. So let's do this. Oh, hold on. We've lost somebody. Oh, excuse me. Just give me half a second because somebody's bad themselves. Okay. Okay. Beautiful. Ori, can you join your breakout room? Ori. אתה יכול להצטרף?